It does seem to me that if there are rules that are mandating a certain level of financing for house purchases for low-income consumers, the banks and the GSEs are in a tough spot. They've got to come up with whatever structure they think does the least damage to their own creditworthiness while complying with the mandate. And we've already made their job pretty difficult.
By the way, I don't know if it's true or apocryphal, but I've heard that one of the main beneficiaries of the current lending situation is the mafia, whose usury practice is thriving.
There you go. Those are excessive rates. Okay, well.
Could the panel comment on the prospect or not of regulation of the rating agencies and the financial institutions' relationship to them?
I can comment on that a bit. There are extensive provisions in the Dodd bill on regulating credit rating agencies. In fact, I think one of the problems with the bill in this regard is that the SEC has actually taken a number of steps since they were authorized to oversee the rating agencies more specifically under the Credit Rating Agency Act in 2006. And a lot of those regulations have really, I think, and rules started to kick in, but I think Congress isn't really aware of the fact that all of those changes are in train, and so there's, a lot of additional very prescriptive regulations called for in the current bills. One thing that, needless to say, has the credit rating agency somewhat alarmed is that the Dodd bill also calls for there to be private rights of action against credit rating agencies, which would have quite an impact because, as you know, they view their ratings as opinions, and to a large extent, what they do is analogous to what a research analyst on a credit product does. But as Commissioner Atkins indicated, what they did took on a whole different level of importance because regulations recognized those ratings for purposes of capital rules and other requirements. So it's a very, very difficult situation because I do think that the structure of that market is sort of a natural duopoly, essentially. I mean, and I think that we could regulate and legislate from now till doomsday, and you're still not going to see, a very robust competitive market in the provision of ratings, as they are used, by the public generally. I think, on the other hand, we do have a lot of competition in the area of credit analysis, but that's not what is at issue here. It's those letter grades that they gave, for the for purposes of regulatory review.
And I think that's the real problem, because like you said, I mean, you can regulate from now till doomsday, but these, in a sense, ultimately are only opinions. They're fallible, and the trouble is that the government has given them special status, and then the marketplace, then because broker-dealers were using these ratings for their net capital purposes, it just became ingrained to give those ratings special meanings. And so that's ultimately, I think, the problem. And so what we have to do is wean ourselves from that, come up with some other standard, and then and not rely so much on these fallible ratings.
I think one of the flaws in the rating process in the whole subprime crisis was that obviously lenders began to tailor those loans to the checklists that the rating agencies had, and that's always going to be a problem because as the instruments get more sophisticated, the really difficult modeling is what is creating the risk. But at the bottom end, you have somebody of fairly menial status making sure that the following things apply to the following loan, and if that's flawed, then all of the data that's been used for that sophisticated modeling is itself flawed.
Well, and I think, as Stephanie implies, I mean, where the problems came up were in the structured area. I mean, generally for sort of straight corporate products, although, there were occasional hiccups with Enron and others, for the most part, what the rating agencies did wasn't nearly as controversial. But when it came to the structured products, that's when the really serious problems arose.
let me, over here, please.
Good morning. I have a question regarding systemic risk from the firms that have been deemed too big to fail. We're involuntary shareholders in many current major financial institutions currently. Are there any proposals or suggestions for how to limit the market distortive effects of these firms that have been deemed too big to fail?
Well, there are lots of different proposals out there, going anywhere from busting them up by force to going to, Paul Volcker suggested, almost like a core banking type of situation where, you know, the insured institution would be limited to very minimal type of product line and business line. You know, to me, you know, part of the problem was, you know, bailing out through TARP and other things. Some of the institutions that, you know, should not have been bailed out and probably should have been left to the marketplace and hyenas to deal with them. But we are where we are right now, and so what we have to be very careful in not doing is digging ourselves deeper into the hole and then institutionalizing, like I think a couple of the bills on the Hill would do, this whole idea of too big to fail.
I agree with that. I think the great danger is that some of the proposals suggest that we, in effect, declare in advance that a list of institutions are too big to fail, which I think would have tremendously distortive effects, because it would mean that they would have preferential access to capital at lower rates. That would just make them grow even larger, and it would just mean that the next problem will be correspondingly much bigger.
Well, people don't remember that back in the 80s, Penn Square Bank triggered major systemic problems in the banking industry, and I guess it wasn't as concentrated as it later became, but Seattle First and Continental Illinois failed and went into receivership, and, you know, it took 10 years or so, but they all got wound up in an orderly manner, and the depositors were protected to the extent of their insurance. Here.
Dean Mahoney mentioned irresponsible monetary policy as a contribution to financial crisis. And I was wondering what can be done about that beyond just hoping the Fed gets it right the next time? And more specifically, what do you think about efforts that have been made to audit the Federal Reserve and make it more transparent?
I do not want to engage in the ever popular game of Fed bashing. They have a hard job, and there were certainly arguments to be made that economic conditions in the middle of this decade were unusual and required unusual policy responses. In hindsight, they got it wrong. I would hope that the lesson that the Fed would draw from that is that in the future, departures from traditional practices with respect to where they are targeting the Fed funds rate should be much more infrequent and have a much stronger and more public justification. But I think the idea that introducing politically motivated actors to nudge the Fed in one direction or another would likely just make the problem worse.
Right, over here.
There's been some proposals for taxing hedge fund managers' performance fees at an ordinary income instead of at the capital gains rate. I was just wondering if the panelists could comment on whether that proposal is gaining any traction, and if it were to be passed, what effect it may have on the financial system as a whole.
When one of my clients called me to complain about that proposal, he said they can't tax me at ordinary income rates. And I said, you're right, I can't imagine anyone who works as a partner in the hedge fund industry who's taxed at ordinary income rates except me.